The top 5 mistakes new real estate investors make. When investing in the real estate market, you must be aware that there is a risk of making mistakes that can cost you dearly. From lack of proper research to not taking tenants into account, these and other errors can negatively impact the profitability of an investment. In this video, I will share firsthand the 5 most common mistakes new real estate investors make. And most importantly, I will give you the keys to avoiding those deadly traps and guiding your investments in the best way. Are you ready to start walking down the path of success as a real estate investor? Let's go. Real estate investing has the potential to generate attractive returns for both new and experienced investors. Properties tend to be a stable and consistent investment strategy that has traditionally outperformed the stock and bond markets in the long run. But, as with any investment, there are risks and easy mistakes. We've all heard the saying that the street is the school of life. And nothing better describes the reality of the real estate market. When you first start as an investor, you're almost guaranteed to make mistakes. Many mistakes are so easy to avoid, if only you knew how. Because when it comes to investing in real estate, the risk of failure is always present. A wrong decision can wipe out your profits and your capital. That's why it's crucial to understand the obstacles to overcome them thoroughly. I aim to share the lessons I learned firsthand, so you can embark on the exciting world of real estate with your eyes wide open. This will help you guide your investments toward returns and profitability. So, let's get to it and take a look at the first mistake that all newcomers make. Mistake number 1. Poor or inadequate market research. The first mistake you should never make may sound a bit obvious, but believe me when I say it's one of the most common. It's buying a home without knowing how you will generate income from it. Before putting your money into an investment, you need to have a plan. What type of property you're looking for and what your strategy will be to make money, whether through long-term or short-term rentals, renovation, subsequent sale, etc. When I started, I was too excited about buying my first property. However, I didn't dedicate the necessary time to analyzing key factors. For example, I didn't consider the area's current supply and demand. Later on, I discovered an oversupply of homes on the market. I also didn't thoroughly evaluate data like rental prices of similar properties or the general economic conditions of that location. If I had done better market research, I would have noticed these red flags, and I likely would have chosen a more stable and profitable market. That's why investment planning goes hand in hand with extensive research on the property. You need to consider market trends in that area and the property's condition, if it requires significant repairs or renovations, and how much they will cost, among other factors. It's easier to buy any property and hope for the best. Still, to successfully invest in real estate, you need a clear understanding of what you're doing, where your money is being invested, and the potential returns you'll get. As you can see, market research is critical to avoiding mistakes and ensuring investment project success. Don't neglect it. Mistake number 2. Ignoring property inspections or issues. Now, let's say you have a property that caught your attention. You've already done your market research, measured the risks and benefits, and you're ready to invest your money in it. But wait, have you even set foot inside the house yet? One common mistake new investors make is neglecting the importance of conducting technical inspections of properties before acquisition. These inspections are crucial for detecting structural problems or hidden defects that could increase costs later. Some anxious buyers overlook this stage and don't hire professionals like architects, plumbers, or electricians to evaluate the property. It's a big mistake because we could be in for many surprises once we take possession. Roof leaks, hidden electrical issues, wall dampness. There are so many things that could undermine your entire investment. Inspections allow the accurate estimation of necessary repairs and the detection of potential structural risks. This enables proper cost budgeting, leading me to the next mistake. Mistake number 3. not accounting for all costs involved. When you first start in real estate, it's common to fall into the trap of only thinking about the property's purchase price. But let me tell you, that's just the beginning. Between acquisition and renting, many other costs can sink your investment. I was so excited about owning when I bought my first house that I overlooked these details. And what a surprise I got when I saw the first $5,000 repair bill. I almost had a heart attack. But that's not all. I also paid commissions, taxes, and notary fees. That quickly added another $10,000 to the initial investment. See why it's one of the most common mistakes. We build castles in the air without doing the numbers. That's why when calculating a property's investment potential to generate profits, you must factor in the purchase price and other costs like repairs, maintenance, taxes, and insurance fees, among others. So, the best thing you can do is assemble a list of all estimated monthly costs of maintaining the property before making an offer. If you plan to rent out the property, you can include the monthly rent in this list to know if income will cover all these expenses. In addition to adequately budgeting upfront, another mistake relates to time. Mistake number 4, unrealistic time expectations. One lesson I learned quickly in real estate is not to fall into the trap of believing everything can be done fast. Yes, I know one of the main attractions of real estate investment is its potential for stability and profitability. But long-term, unlike other higher-risk, volatile assets, real estate is usually approached with a medium and long-term outlook. However, when I first started, I fell into the trap of wanting ultra-fast results, forgetting the very nature of this market. I wanted to see sizable profits within months when real estate logic indicates letting time take its course. My mistake was trying to force the business, rushing deadlines out of my control. This led me to exceed costs, delay rents, and compromise my projected profitability. But real estate investment demands patience to allow your capital those years it needs to grow steadily. It's about projecting long-term scenarios, not expecting overnight fortunes. I could have avoided stumbling if I understood earlier that a year-long vision is required, not months. The key is being patient and trusting that, over time, your properties will build a solid asset base. Now, let's move on to today's last key factor. Mistake number 5, not taking tenants into account. Many get started in real estate wanting to rent out their first property without genuinely understanding the different requirements of tenant types. However, knowing your target rental market audience is fundamental to long-term success. While the idea may be to generate rental income without adequately understanding tenants' needs and preferences, there is a risk of ending up with an empty property. The mistake of not paying attention to tenants goes beyond mere property management. Even at the investment planning stage, knowing the profile of potential renters the property will target is vital. For example, if I plan to rent to families, I should acquire a home in a safe area with good nearby schools. I know educational quality will be a determining factor for them when choosing where to settle. If my goal is university students, I'll need to consider neighborhoods with excellent public transport connectivity so they can get around comfortably. Nearby amenities will also be essential. And if I want to target tourists, I'll need to focus on central locations according to the area's attractions that motivate stays. By buying without fully understanding my future renters' motivations, you risk acquiring a property unsuitable to their needs. Considering these factors helps purchase a beautiful and profitable property for potential tenants. Otherwise, it can end with an empty house and unpaid bills. Understanding the target market's needs well allows investors to enjoy high occupancy rates and stable rents long-term. As they say, knowledge is power. And that wraps it up for today. I hope this video has served to help you avoid falling into the same traps when getting started in the real estate investing world. Remember, you must thoroughly research the market, inspect properties in depth, plan realistic timelines, understand your target audience, and give proper weight to tenant management. If you found this useful, don't forget to like the video and subscribe to the channel if you haven't already. Before I go, I'd like to know, which mistakes do you think most new investors fall victim to? In the comments, let me know which trap you feel is the most straightforward to fall into. See you in the next one.